Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. If you're loving what you're hearing on the podcast, I'd be very grateful if you took a minute or two out of your day and left a review on Apple Podcasts, what used to be called iTunes. These reviews help make the show more visible to new listeners in the search algorithms. On today's show, we're going to make an important distinction between two words that are often used interchangeably, but have vastly different meanings. The two words are pain and damage. When you hit your thumb with a hammer by accident, you'll experience pain. In fact, the pain will be so acute that you'll think of little else for the next few minutes. Eventually, the throbbing subsides and you can get on with your day. Now, I know the weekend handymen are cringing as I'm describing this. I know you can clearly visualize the last time this happened, and the mere mention of it takes you back to that moment when the hammer slid sideways off the nail and made contact with your thumb. No doubt you were in pain, but if you hit it really hard, you could actually break a bone. And then the impact is much longer lasting. You might have done enough damage that in fact the impact could be permanent. The context of today's discussion is not your thumb, but the economy. There's no doubt that individuals and companies the world over are experiencing economic pain. The bigger question is, where in the economy are we experiencing damage? When Hertz Rent-A-Car has next to no clients for 2 months, they're experiencing economic pain. And when they're forced to seek creditor protection using bankruptcy laws, they're experiencing economic damage. Some companies manage to convince a bankruptcy judge to restructure some debt and then reemerge from bankruptcy as a viable business. This takes time. It results in a shrinking organization. In other cases, the bankruptcy judge will figure out that the business is too far gone to ever recover and will be forced into liquidation. At that point, the damage is permanent. Now, you might not have the ability to single-handedly save Hertz. We have about 700,000 cars in the fleet. The company leases its rental car fleet from separate financing subsidiaries, special purpose entities that issue bonds backed by the cars. Under this asset-backed securitization structure, the lease payments are earmarked for investors such as pension funds and mutual funds that own the bonds backed by the vehicles. Now, Hertz has to make monthly payments to compensate the creditors if the vehicles backing their debt decline in value. Now, there's no doubt that the bondholders want their money, and the problem is that the market for used cars is flush with inventory right now, which is pushing prices down. A fire sale of assets to reduce the size of the fleet would actually do little to raise cash. Many of the company's 12,000 rental locations are franchises where the franchise owner buys or leases the vehicles. Hertz is going to experience lasting damage, and so will thousands of Hertz employees that will no longer have a place to work. But companies don't need to be over-leveraged like Hertz was in order to experience damage. I'm going to tell you the story of a restaurant called Stone-Faced Dolly's. This restaurant has been a fixture in Little Italy for decades. It's a family-owned restaurant, and multiple generations of the family are involved. The problem is that the founder of the company is now 75 years of age. They have 3 locations, and the owner is tired. He doesn't have the energy to restart the business when the economy reopens. He believes that reopening is going to involve some heavy lifting, and he simply doesn't have the emotional fortitude to go through that at age 75. He's not alone. I've spoken with 3 restaurant owners in the past few weeks. All of them are thinking of throwing in the towel. They're not bankrupt. They're not even in extreme pain. They're just tired. But when these businesses have no succession plan, no sale plan, and no viable path to reopening, they just die. This, folks, is the very definition of an opportunity. When a significant percentage of restaurants close because they can't see a way back, those that will remain will eventually have an incredible amount of business coming their way. It might not happen in a month or maybe even 6 months. Economic pain is becoming economic damage, and that damage is occurring for a variety of reasons. In some cases, the businesses were carrying too much debt to survive the current market conditions. In other cases, their competitor got a bailout check and they didn't. But in some cases, the owner is just tired. The opportunities to find viable businesses for pennies on the dollar are becoming apparent even now in the early days of this pandemic. As you think about that, have an awesome rest of your day. Go make some great things happen. We'll talk to you again tomorrow.